Aloha and mahalo for joining us today for Retirement Savings Options. I'm Amber Millsap, Community Relations Officer with Hawaii Central Federal Credit Union. To begin, I want to thank Olelo Community Media for helping us to provide this financial education service, not only to our members, but to our community at large. With me today is Herb Hussey. Herb is a partner with Windward Financial, and he has been in the industry for more than 30 years. In fact, Herb served on our board at Hawaii Central Federal Credit Union. With that, and in the understanding that we may have people joining us for the first time, Herb, I'm going to ask you to tell us a little bit about yourself.
I've been a retirement planner since 1990 when I was working for American Savings. I retired from there in 2005, I believe, and I've had a small company since then. My area of work is retirement planning, particularly for people who work for the state and county and their families.
Well, thank you, Herb. I guess it's presentation time. Herb has prepared a presentation for us today. So are you ready to start with that?
Sure. We have to kind of do this as we go along, so can I have the first slide, please? All right. Retirement savings is the area of retirement planning most people tend to focus on first because they tend to think, rightfully so, that retirement planning is about having enough money to carry us for the rest of their lives. Interestingly, while people focus on the question of money first, as they get closer to retirement, the issue of medical care becomes more prominent. And then other issues as well. For example, what are they going to do after they retire? Is it just going to be staying home and watching TV? Or do we have other things in our lives that we want to do? Next slide, please. One of the things that people often say is, well, what should I invest in? Where should I put my money? Actually, the question I think is better asked by first focusing on what certain terms mean. And in every profession, there are terms that are known as terms of art. They are specific to that profession, specific to that task. And if we understand how those terms work and what they mean, we have a better sense. It's not about action, it's about understanding. Next slide, please. First word that I think we should think about and understand is the word of tax status. When we hear the term, it's kind of one of those terms that doesn't seem to speak to what it is, but actually the question of tax status when it comes to retirement savings tells you how long this investment can be yours before you have to start withdrawing funds and paying the taxes on it. So tax status becomes a real driver. It's one of the more important decisions about things. Next slide. And when we think of tax status, there are three different terms that come into play here. Let me go through them. These are critical. Tax deferred. The operative word here is not tax, it's deferred, which means we're not going to tax you now, we're going to tax you later. Accounts that are, let's say, IRA accounts that are 401k accounts, these are tax deferred. It means that while you're putting the money away now and getting a tax break for doing that, there will come a time when you're going to have to take the money out. All right, so tax deferred is one type of retirement account. It is very prevalent, but it's just one type. Next one is tax-free. And everybody likes free, and tax-free basically means that you can put the money away for yourself, but later on when you withdraw the money at the point of retirement, you pay no taxes at that point. Probably the best known tax-free account is a Roth IRA. The difference between the two is profound. When you factor in taxes into an account calculation, a tax-deferred account is probably going to be subject to about a 30% loss because of taxation. Tax-free, on the other hand, is exactly that. There's no taxes.
When we're talking about tax status, I'm thinking, I actually it's not really tax-free, right, with the Roth IRA because, I mean, it's tax-free at retirement, but
Right.
I have already paid taxes on that money now,
Correct.
right?
Correct.
So I guess my thought is, so if it's tax deferred, I have maybe 30% more money to play with in order to grow,
Yeah.
whereas tax-free, it's whatever I can put in after my paycheck.
That's
right?
correct. That's correct.
So I guess there's pros and cons on
There-
each side.
Exactly right.
you
There's
know?
pros and cons to all of it. Which one? There's no one of those approaches that's absolutely better than the other. The important thing is to understand the difference. Because if we go down a road that's say tax deferred, there's a reckoning for this, right? If we go down the road where it's tax free, we'll say, well, I pay the taxes on the back end and on the front end. It's true. You pay the taxes at the front end. What happens is the growth going forward is tax free, not the whole thing, all right? But what happens with a Roth account is that there's limitations on how much you can put in. Whereas a 403B or a 401k, the amount that you can contribute is much, much higher. So there's different gradations of understanding that have to be there for the person. All right. People tend to think, well, we're told that when we retire that we're going to be paying less taxes. Yes, but more than likely that's about having less income. That may be the reason why we're paying less taxes. So when I talk about a tax status, we're talking about making a decision at the front end about what kind of tax feature we're going to be looking at. Tax deferred, tax free. Last one is taxable, fully taxable. An example of that is a savings account at a bank where the money that goes into it, the interest that's earned, every 12 months, they take that interest and they add it to your taxes. Taxable income is good in a sense that every January 1, it starts again. Whatever is there belongs entirely to you. You don't have to pay taxes on any of it. That's because you're paying taxes all the way along. So one of the first things I would suggest to everyone is when we look about what we're going to do in terms of savings for retirement, we want to think about which one of these approaches do we want to take. That's why the approach that I suggest for people is don't focus on the investment, focus on what you're trying to accomplish, and then figure out what works best. Are you okay with paying taxes down the road and you think that you're going to be putting more money in over time and you want to take a tax break now? Tax deferred works. If it's I can only put this away and I cannot do any more and I don't want to deal with any taxes down the road, tax free is better. But if it's, you know what, I want access to my money all the time, every year, and I pay the taxes from the past, but when it come January 1, if I want to take it out and spend it, I can. Then a fully taxable account.
And you, again, when you're talking about a fully taxable account, what exactly, we're talking like money markets, things like
A
that?
savings account.
Yeah.
A savings account at a credit union or a bank. The interest that's earned there does not compound. What happens to it is that it's credited to your account at the end of the year, and that's what you have to pay taxes on when you file taxes that year. But what it also means is after you pay the taxes, every dollar in your account is yours, and you've paid the taxes already. So you could theoretically just say, you know what, I'm going to take it out and spend it. That's why a fully taxable account makes a lot of sense for retirees, because when they take the money out, let's say January 1, they take it out to go travel, there's no tax hit because they paid those taxes over the years, right? Whereas if they pull the money from an IRA, bingo, the taxes are there because none of it has been taxed. So that's why rather than telling people where to put their money, my suggestion is, how do you want this thing to be?
How do you want it to work?
How do you want it to work? Additional terms. So tax status is the first step, but beyond tax status, there are other terms of art that have to be understood to figure out what the person should be doing. First one is the investment horizon. How long before we need the money? If we need the money next week, putting it into a long-term investment is not going to work at all. Okay, if we say, okay, we're going to put the money away and I don't anticipate needing it until I'm 50 or 60 years old, I have a longer horizon. And the horizon oftentimes determines what type of investments I can be putting my money into. All right. So beyond tax status, the investment horizon becomes critical. And it's important for a person to be clear on that. What happens, like, for example, if they put their money into a CD at a bank,
Yes.
what the bank does is that they turn around and they go out and they buy investments to support that. If on the other end the person shows up the following day and says, I need all my money back out, the bank, like other financial institutions, will assess a charge because they have to liquidate that account sooner. Another one is risk tolerance. Okay, how much risk are we willing to accept? All right. When we have monies in a CD, the risk tolerance is very low. The risk of the investment is borne by the financial institution. If you have a fixed or indexed annuity, the investment risk is borne by the financial institution. They bought the products to support that. It's usually bonds of some type to support that. But if the risk tolerance is such that, you know what, I want a greater rate of return, then the question is, are you willing to accept potential loss? If the answer is, yeah, I'm willing to accept it, then you could step into areas there where you are maybe investing in mutual funds. Okay. Or if you say, I really believe this particular industry is going to be really successful in the coming years, I want to buy that stock. Again, you're doing it, right? But then again, it's about risk tolerance. The last one is, okay, do they have a retirement pyramid? In other words, if we are saving money for our retirement, have we also put the foundation into our investment pyramid? The investment pyramid is the bottom of that I guess that financial structure that we're creating for the long term. The question I try to ask people is this: if you look at the pyramid that's sitting there on a hill, or if you look at the houses that are on the hill, or any kind of building like the skyscrapers in New York City, for example, we can see what's above ground, but it's what's underground that's holding it up. If that thing underground is not strong enough to hold it up, it will fall down.
Foundation.
So before I suggest to someone, go open up a retirement account of any sort, I will want to know, do you have a job? Not a job just this week, but a job. Do you have emergency money in case you get really, really sick? Because if you have a job and you get really, really sick and then cause you to lose your job, your retirement money is not going to be funding. You're going to take it out because you need to live. So you have to have a job. You have to have emergency money if you get sick. If you are married and you have children, do you have life insurance in case you die? And then the fourth one is, do you have a simple savings account that has $500 or $1,000 or $2,000 in it that you can go get money out of today if you need tires for your car? If you don't, then don't put money away into any of these retirement accounts, because what will happen is your car will break down, then you're trying to pull money out of your IRA, get hit with the taxes and the penalty. So the pyramid begins underground. So the terms of art, number one, okay, the tax status, okay, the risk tolerance the person has, their investment horizon, and then is the foundational part of their retirement plan there.
And when we talk about her investment horizon, I often hear, and correct me if I'm wrong, that as you age, it's recommended that you're not investing in things that are as risky because you don't want this kind of up and down.
It really comes down to an individual choice and individual style. Some people, from the time they are young, are risk adverse and they want steady growth, they don't want drama, and they don't want change. I understand that. Other people who are retirement they're investing in the market, they're moving funds from this account to that account because they enjoy it. Okay, it really comes down to individual style. But what I've noticed about people that have a really good sense of what they want to accomplish is that they're not driven by a product. They're driven by a sense of trying to accomplish something that benefits them.
So a goal.
To a goal, rather than I want to go buy that. No, no.
It's not just I'm making money. I just want to make money. That's not the goal. I want to retire and maybe have a roof over my
Take care of
head.
my family.
Yeah. Okay.
I want to be safe and happy.
Those are
Okay,
good.
I want to be
goals.
I want to be able to travel with my family. I want to leave something behind. All of those goals are very, very important. So what I try to suggest to people is don't focus on the product. Focus on your goal. And if your goals are mismatched, in other words, you bought a mutual fund, but you are not risk tolerant. We're in the wrong place. We need to get out of there. Or we have money in a CD, but we really would like to be involved in mutual funds and all of these other things. Again, we have a mismatch. When we have a mismatch in any kind of activity, any kind of human activity, it leads to failure.
So I guess it really comes down to your financial planner and having a good financial planner who can guide you through this.
No, I think every person who's thoughtful about what they're doing, okay, has in their own mind, in their own lives, a plan. And oftentimes when I talk to my customers, my clients, they can describe to me their plan. And then when I understand the plan, I go, okay, makes sense. Makes sense.
I'll just say in the past, I've worked with financial planners and I've just not felt comfortable because it was like a one size fits all.
Yeah, everybody needs my
know.
cheeseburger.
Yeah, and I was like, wait, what? I got to pick plan option 1 with ABC, 2 or 3, and that's it. And I just kind of felt like there has to be more out here. So
Sure.
you did mention, before we move on, annuities, fixed or indexed.
Yeah.
I'd like to learn the term, even though
Okay.
we shouldn't be focused on the products. I understand.
Okay, there are two kinds of annuities. There are the variable ones where they are in sub-accounts that have mutual funds that they can select, or they can have a mutual fund where there are different indices that they can choose. The difference between the two is that a variable annuity can go up and down in value. A indexed account, on the other hand, can go up, but if the market falls and the indices doesn't make money, the account doesn't grow, but it doesn't drop.
Interesting.
Yeah. So therefore, once we've kind of understood our goal and we understand our risk tolerance and those sort of things, then we can sit with a person that you choose and you can identify what kind of product matches the goal you have. Required minimum distribution. This goes back to the deferred tax issue, and if you pass away, to the Roth. This is an issue of significant concern for most people because this is when the taxes have to get paid. Now, a fully taxable account doesn't have a required minimum distribution, and Roth accounts do not have one while the person is alive, all right? But required distributions are there for tax-deferred accounts. What it means is this. The operative word here is deferred. I grew up in Kalihi. What that meant was not now, later. And the later comes, depending on when you're born, around 72, but I think they just changed the age to 73. And at that point, what happens is all of your tax-deferred accounts, okay, the government will now come back and say, of the value of all of them, you need to withdraw a certain amount, right? Now, what happens is you have to withdraw that certain amount, you pay the taxes on it, and life goes on. A year later, you have to do the same thing. The required distributions are a requirement for the IRS, right? And it's important for them it's important to make sure that we abide by that because there are going to be consequences if this is not done.
And it seems like really far away. But I mean, a lot of people think that, right? That's
really far away, 73?
Yes.
Yeah, that was last year for me.
Oh, I'm sorry. Okay.
Thanks. Mahalo. Oh, okay, good. You can take your IRA and make it into a lifetime income, all right? And the question is, do you want to, the question for my clients when I ask this is, do you want a pool of money that's basically there and you use it up? Or do you want a lifetime income, which is a hose, which is money that's going to pay out to you over your lifetime? if this fits your goal, talk to your advisor and tell them this is what you would like. And if they try to steer you in another direction, tell them, no, I want this. Because remember, it's not their account, it's yours. So you're the driver in this thing. Other retirement savings options. Life insurance with cash value. This is an interesting one, because what happens there is that they take like a cash value life insurance policy and they overfund it. They put more and more money into it because there are two things that happen in a life insurance policy. One is that the cash value, not the death benefit, the cash value grows tax deferred. So if you're putting money into it, there's guidelines and stuff, but like the whole account will go tax deferred. And then they use a mechanism within these life insurance policies where they are making loans. They're making withdrawals. So the money comes out tax free. Let's say you have two different scenarios: $100,000 IRA, okay, that you're inheriting, or $100,000 life insurance payment. A $100,000 IRA, you're still going to have to pay taxes on it, even if you're the spouse and you're inheriting it. That R&D, the required minimum distribution, kicks in. You now own it, you have to pay it, right? But that death benefit from the life insurance is tax-free. So this one over here is, in my view, much more valuable than an IRA, because you're going to lose a third of that IRA to taxes, whereas a life insurance benefit is tax-free.
Now, are we talking about whole life insurance?
Any kind.
Or term?
Any kind of life insurance that is paid for by the person, they own it, and the beneficiary is someone they know and care for. They have an insurable interest. When they pass away, that's what's done. So one thing that people can do is, if the income is on one person's side of the ledger, and they have a couple, but one person has the income, what they can do is rather than trying to create a taxable IRA over here for the other spouse, is they carry a large life insurance policy. And they're saying, okay, we have the money here, okay, the accounts are all mine, but we carry a very large life insurance policy on me on insuring me. The beneficiary is you, the wife. So when I pass away, this money goes to you. It's tax-free.
That is awesome.
Oh, yeah.
Nobody likes taxes. I certainly don't.
Real estate,
Rental
income. This is something that a lot of families in Hawaii have done over the years, is that they start off by buying a home for themselves to live in and another nearby home that they rent. And you think, why would they do that? Well, over time, what they do is okay, we have money coming in, all right, we buy another home and then another home. What they end up having as the family ages is that the other homes are now providing retirement income for that family. They become landowners. The money that's coming in from the rental of these rental properties is now providing an income. And it begins very, very simply. Families start off saying, you know what, I have enough money for a condo for me and my family, and I have enough of a down payment to put money down on another condo. Why would I do that? Well, instead of maybe buying a fancy car or doing something like that, I can now rent this. And that rental income is my income for me. Very smart. Very simple approach. A lot of local families have done that.
And it's not just something, though, that is unique to Hawaii.
No, it's not. It's not unique. It's not unique to Hawaii, but I've seen it a lot in.
You see it happening here. Creating ongoing business?
Yes, really good one. Make a business. Make a business of any kind, okay? And and as you age, what happens is, if you hire good people to run the business, what you want to do is make sure that what you're paying them, okay, is lower than the income coming in. So what happens is that little bit of buffer, okay, that's your retirement income when you're elderly. You run a business. That's why oftentimes you see families that will say, you know what, I'm going to be doing this. I'm going to hire my son, and my son is doing this. Okay, why? Well, as the older person in the picture, what they're doing is they're running a simple family business, and they hired somebody to work hourly to run the business, but they get a little bit of income every month. That's their retirement income.
You know, I didn't expect that coming from some, well, a retirement planner, but they definitely are alternative
Planning their retirement.
ways of planning your retirement.
Sure. We tend to think of retirement planning as a bunch of products. It's not. It's a process. It's a process and a goal. And it's like, okay, how do we do this? What do we do? What do we do?
But most financial planners will not tell you that.
I know. I
Those
know.
sorts of things. That's why I'm
Yes.
surprised you're talking about this as a retirement planner yourself.
Oh, yeah. Because to me, the key thing is that a family has to figure out what they want to do and how they're going to do it. And if they can figure out those things, if they have a goal, we want to do this and we don't want to do that, we want to go do this, okay, fine, do it. In the end, whether it's anything else they can. One of the coolest ideas I've heard about, I think it's on the Big Island where they can you could, if you have land, what you do is you grow trees, like koa trees.
Oh, yeah, I've heard of this.
Right. You put up koa trees. They take like 25 years to grow. But 25 years from now, when you cut them down, somebody's going to buy them and you're going to make money. So what people say, well, why would I do that? Well, imagine if you have a big enough plot of land, the first year you put in a bunch of trees. 25 years later, that's the ones you're going to harvest. Next plot of land, next year you put trees over there. So 26 years from now, that's the one you harvest. Down over there, 27 years from now. So every year you go along, you're planting trees.
Don't tell anybody. I didn't do this. No, just kidding. Just joking. But anyway, and that's what I love about you, Herb, is that you're always full of ideas, and I don't feel like you're trying to sell me a product every time I talk to you. So, are we done with that slide? Are we done with the presentation?
I don't know. Are we Paul? I'm Paul.
I don't think we're Paul. I thought there was one more slide at least.
Okay, one more slide. Talk to your advisor. Have a conversation with him and have a chat.
We had a lot of very informative conversation with you, Herb. I want to thank you so much. And I'm going to be processing this for a few days now. But,
I thought of putting up koa trees in my backyard.
oh, really?
Oh, yeah.
Do you have enough backyard?
We have enough room. I go, oh, you know what? I should put one up per
Wait,
year.
How many acres? You have acre?
We have a quarter of an acre.
Oh, nice.
Yeah. I thought, how many
nice.
trees can I put up over here? Well, what is retirement planning in like that? What you're really doing is you're creating a source of income for the future. Period. That's all it is. You're creating a source of income for the future. Makes sense to me. You can convert this thing into cash later on when you need it. Yep. Okay. You win.
Well, thank you again so
You're
much,
welcome.
Herb. I can't wait till we're back here again.
Okay.
And I just want to end by thanking our guests that had joined us via Zoom. I want to thank them for their patience, and I want to thank Olelo Community Media for having us today and helping us figuring out all this technical stuff in the background. Really
Yeah.
appreciate
Thank you for that.
that.
Thank you for that. That's complicated. I'm glad you guys are very, very competent about that. Thank you.
Definitely. And with that, I want to say thank you and ahui ho. I look forward to seeing you next time.
Bye.